You're listening to Accounted For, the Canadian podcast that explores the intangibles of every career. I'm your host, Daniel Lee. Hey everyone, welcome back to Accounted For. Happy Wednesday. This is a podcast on a mission to expand your perspectives, have you question the status quo, and get you inspired to action for your own career. And I am very happy that you took the time to join in once again. And I'm happy to be back after a good 2-week break, although I was sick for a full week and a half of that 2-week break. But I am happy to be back to present to you with more episodes for these next coming months. Until my next break. And so if you are a full first-time listener, you might be a little confused, but this podcast is kind of part of this overall platform I've built called OMD Ventures. And the platform itself is on a mission to build utopian organizations by unlocking human potential. And so if that sounds confusing to you, that is a great reason to check out the platform. So go to omdventures.com or alternatively oldmandan.com, and you can learn more about the podcast as well as all the stuff that I'm doing as well. And if you are a long-time listener, please I would say support the community by signing up to the weekly newsletter. It includes everything from the weekly developments as well as the daily learning. That's something that was public, that went out every Monday, but now I've decided to keep it closed just for the newsletter community. So now that's even a greater incentive for you to sign up. And if you want to somehow support the podcast so that it can help grow it further, like, I don't know, help me pay off all the overhead fees, then please donate. And you can find all that in the stakeholder option in the website. Or alternatively, the address is omdventures.com/stakeholder. So that's all the everyday announcements. Oh, and separately, I used to, well, as of like last week, I think I had a separate YouTube channel where I had a separate vlog called The Boring Life, where I went through what I would go through every week trying to create this company of mine and all the major ups and downs that I go through in this weekly episode. And I decided to pause that just because I just wasn't having that much fun with it anymore. But I'm thinking of combining that into a separate podcast that's much less serious than this one, but more focuses around what I do every week, but at the same time, something more dear to my heart, which is kind of the fact that I'm a minority. It's not going to be anything like some race-based thing, but just using the concept of being a minority wherever you are, in whatever field, in whatever nature, and using that as a conversation topic to talk about things. And it might be a solo thing that I do by myself. I might have a guest on where I just use it as a reason to just catch up with a dear friend. But yeah, I figured, especially for us Canadians in the millennial generation who are immigrants of some sort, there really isn't much of a voice out there for us. At least for me, as a Korean, all the voices I hear are Koreans in LA, and I cannot relate to any of them because we just live a completely different life, in my opinion. So I thought maybe I'll just start one myself. But yeah, it'd be cool to hear back from many of you listeners if you would be interested in something like this. And if the outcry is really positive, I'll speed up the production of it. If the outcry is non-existent or negative, I might just maybe slow it down. But I think I'll still end up just doing it just because why not? But yes, that's it. That is it for announcements. So today is another anonymous episode, and I experiment with a number of anonymous episodes in the past where I would get someone in various professions, like at a hedge fund or management consulting, and we would sit down to have a candid conversation with what these individuals would actually do in their day-to-day lives, as well as go through what their industries would actually be like as well, and challenging the popular myths that people would have about particular industries. And so by popular demand, I'm constantly finding more brave souls who are looking to share what they do and what their industry is about. And so today is about infrastructure investing. Working on my pronouncements. Infrastructure. It's a field I've personally had a brief exposure to, but it's also a place I'm not that familiar with. But I've been recommending people look into it, especially when I have people coming to me about investing and they tell me, oh, I want to be an investor, but they want something that's much more lower volatility, something in the private markets, and they wanted a career that might be much more data / Excel heavy, where they can be very detail oriented. And so for those people, I tell them, oh, have you heard about infrastructure investing? And I'll recommend that field to them. And my initial experience and understanding was that it's like investing in hospitals and airports and solar panels. Renewable energy was my personal experience, but I wasn't too particularly aware of the details of what it was actually like. And so I grabbed a person who is an infrastructure investor themselves and had them on the podcast. And so we do like a deep dive into how infrastructure investing actually works, what that person does in a day-to-day, as well as just more of just the industry trends around what this kind of field is like. And so, yeah, if this is something that might be interesting to you, then you're in luck. Even if you aren't, you'll still learn something about a new industry. And especially for Canadians, this will be interesting because we live in some kind, a version of a very socialist type country where, the government takes care of healthcare and education, but you will end up learning that private investment companies own these buildings and infrastructures. So, like, how does that work? How is the government operating it, but at the same time paying investment companies to own it and operate it themselves? So these are things we'll kind of dig into as well. So that might be of use to you as well. So I really do hope you enjoy this anonymous podcast interview on infrastructure investing. Hey everyone, welcome back to Accounted For. Today is another series on the Anonymous podcast. And so we are going to explore the world of infrastructure investing in Canada. And so I'm first gonna, as you all might be aware, if you've listened to any previous anonymous episodes before, you will know that I never revealed the guest's name. So I'll just say, hello, thanks for coming on the podcast.
Thanks. What's my name?
So previously, I used to call all my anonymous guests Min because that's a gender-neutral Korean name. So I can call you Min if that works. But I've also learned that I never really end up referring to them as Min ever. So, but I'll just introduce you as Min. And so the first question I have for you before we even go into infrastructure investing is the years of tenure you've had in this field. So over under on the 3-year mark. And for the guests, I use 3 years because I found that when people stay in a field for more than 3 years, they tend to stay for quite a while. And when people stay under 3 years, they tend to still have the flexibility to leave to something completely different.
So right now I am under 3 years.
All right. Are you getting close to the 3-year mark, or do you think you're gonna bounce?
Getting close. I'm keeping my options open, but I'm not gonna commit to anything yet. But yeah, getting close to the 3-year mark.
Okay. And so for our listeners who may not be familiar with what infrastructure investing is, can you explain that to the audience, in a way that you would maybe even explain it to your parents in like a very kind of easy, simplistic manner?
Yeah, so I think the first thing I would do is define what infrastructure is.
Excellent, yeah.
So, when people hear the word infrastructure, they might be thinking of these huge kind of projects with the government where they might think of like highways, hospitals, schools, that kind of thing. But lately, infrastructure has kind of like expanded beyond the traditional infrastructure kind of boundaries, and has moved on to include a lot of power projects. Like a lot of renewable energy now falls under infrastructure. And in fact, like the company that I used to work for only does renewable energy. And outside of renewable energy, there's also this new space that's kind of popping up now called digital infrastructure, because digital and data and all that kind of stuff has been like such a big part of our lives. Like I can't imagine a life where, you know, internet is not accessible to most people. Like, you know, what are people going to do? Like, how are people going to do their jobs if they're not like connected to the web? And so lately, digital infrastructure is starting to be grouped into the infrastructure space. And so asset-wise, those are like probably the bigger categories of assets that falls into infrastructure. And so if I have to talk about what infrastructure investing is, you know, those are the assets that I include. And the next thing to think about would be the kind of economics of the assets. Like infrastructure investments usually are long-term kind of investments that provide like a steady return. They're not very risky. So the target IRR there is not very high. Like most of the infrastructure investing only goes for a very low IRR in like the maybe like a 5 to 6% kind of mark, all the way up to, well, when you go into double digit, you're getting into like the risky infrastructure type of investments, which we call core plus. Core being like the traditional stuff that I talked about in the beginning, and the plus being like the additional stuff that you're tacking on. So renewable energy is falling into the core now, and the digital stuff is kind of like what I would put in the core plus space. So yeah, in all in all, like that's kind of how we describe what infrastructure investing is, and it's kind of helping the clients put money into these assets to generate a long-term stable return. Like they're not out here looking for to double their money. They just want to make sure the money is kind of growing a little bit more than inflation and keeping the value.
Got it. Yeah, and so I think you mentioned IRR, so that stands for internal rate of return for our non-financy listeners. And so if we could kind of paint the picture, I think if we were to give a range, so infrastructure, you said, you know, if it was a core investment, so in, I guess, now it's a bit of renewable energy, but I guess that's also, there's probably some renewable energy that's still in the core plus. But I guess then the main chunk would be things like highways and I don't know what else it would be, like toll roads or I guess hospitals.
Toll roads is, if you think about how toll roads work, like it kind of falls outside of the core, because toll roads, the way you make money is if people pay to go on your toll roads. Like if you're in the Toronto area, like think of the Highway 407. It's not a very stable kind of return because, you know, if the economy goes really bad, people are going to like cut back on how much they go on the 407 because, you know, that might be like a luxury kind of spend to the lower income kind of family. And so your return in that sense, it's still kind of subject to the economic cycle. And if you think about infrastructure assets, most of them are not really subject to economic cycles. Like because you're getting money from generally one counterparty, and it's usually like think of a solar farm. Like you don't collect revenue based on how much electricity each of the individual households spend. You collect money from the grid provider who you're selling the power to, and that's one counterparty, and they're going to pay you regardless of whether the economy is going good or bad because they sign a contract with you to provide that income. And that's kind of like the backbone of infrastructure investments. Is a lot of stuff is contracted, and you're not really subject to a lot of revenue fluctuations.
Oh, okay. And so if you can, if I'm thinking about the core investments, then so you know, solar is still part of, I guess, the renewable section, right? And then what are the kind of the major investment types inside the core stuff?
So the core stuff is generally a lot of very public assets like hospitals. This would be a core infrastructure, schools, even libraries. Like, these are assets that are out there to provide general public good for everybody. And in turn, you know, the government usually pay you some sort of money to operate these assets. And that's where they make money from is to keep the asset operating at a good condition and to provide public good, and the government will pay you money as long as you keep it up.
Oh, okay. So I always thought the government actually owned a lot of these. So then it's a infrastructure investment company that owns these assets and actually operates it, and then they get a fee from the government that pays them to maintain it.
So in the industry, there's a term called P3, and that stands for public-private partnerships. And so usually the government would have like a mandate to go out there to build a new hospitals to provide, you know, services to a new area or something like that. And to build that new hospital, the government is usually going to go out to the private market and have like an RFP, and then everybody would bid on it and see who can. I guess they generally look for who can provide it at the best cost. And but on top of that, they gotta also make sure that the private company building it is not going to bail halfway, and they have a good group of parties going in bidding into this asset to construct and to operate. So they would bid into it, and the government would essentially sign this agreement with this consortium of partnerships, saying that if you build it, then the design build guy is going to get paid, and then after you construct the asset, the design build guys go away after they've built the asset, and then the equity provider and the operator of the asset comes in and operate the asset for the remaining term of the contract, which it could be anywhere from like 20 to like 4 years. And for the entire time, they just have to maintain it and keep the asset in good shape, and the government will pay them like every month or quarter, depending on the contract. Usually every month, because they need to have the cash flow to operate the asset. And then at the end, a lot of times there is something called a handback in the traditional infrastructure, and in the handback is you kind of maybe you have to do a little bit of refurb to bring the asset back to like a good condition, and then you hand the asset back to the government after 40 years.
Oh, wow. Okay.
Yeah.
So they're signing really long-term contracts from the get-go.
Yeah.
Like they build it and then they go, okay, here's a 10, 20, 40-year contract.
Yeah.
And so run with it. And so that's, I guess, how you have the stability. Like, literally that unless the country doesn't do well as a whole,
exactly.
You'll get paid.
Yeah, exactly. And like these government, like municipal or provincial government or any government body usually have like a pretty high credit rating, like it would be up in like the AA kind of area, and that's why a lot of infrastructure projects are actually very highly levered. Like you could have up to like 80% of the project value that's funded by debt. And that's kind of what you need to bring the returns up, because if you just look at an unlevered project, most of the time you won't be able to get up to like the 5 to 6% return range that I'm talking about, let alone like the higher like single digits. And so you have to really lever the project up to generate a reasonable return for the equity provider.
Right. And I guess if I were to try to simplify for people who might not be familiar with all these investing terms, so when you lever it up, you're injecting with a lot of debt, and it's like, I guess like the simple definition or example would be like when people buy a house, right? They might just put in the cash, their equity component as like a down payment, and
Correct.
then the mortgage being the levered position. And if you sell the house after it, fingers crossed, doubled, then that whole value is a huge gain on the actual initial equity position you would have had, which was your down payment, and you can use the rest to pay off the mortgage or whatnot. But that leverage allowed you to benefit from that return.
Correct, and that's what makes infrastructure investment like so attractive, right? Because if you think about the project, it's relatively low risk because your revenue profile is kind of almost guaranteed, and so you would generally always have enough money to pay down the debt and still have some money left to pay out to investors. And that's why they're willing to fund equity to only asking for like 6% of return, and not take on any extra risks.
Yeah, and in an environment where your risk-free rate is maybe sometimes even 0% for some countries, but even maybe like even 2%, the 6% becomes quite attractive when you think about, it's very stable, just like a bond is, because it's practically. It's still the government is still the main client, especially in a very kind of more socialist style economy like in Canada.
Exactly. Like right now, like the yields are very low. Like they're down to like the mid twos probably. And if someone comes and be like, okay, you can put in your money and you're almost guaranteed to earn like a 5-6% return. Like, why not? Right? And I can earn that return for like 30-40 years.
Right.
It's not just earning it for a few years. Like a bond.
Yeah, and so I forgot to mention this caveat, but for the listeners who are still listening, this is not an investment recommendation podcast. It's an informational podcast. So make your decisions at your own, peril or success, whichever. But this is purely informational, so don't think we are recommending anything. Although it could be that I consider it to be a recommendation for me as I learn about this field. And so then, I think if I think about the IRRs of other asset classes, like infrastructure being one asset class. I think if I think back to the public equity world, I think even getting like 10 to 15% is still considered like a very good fund manager in the public equity world. And if you have, some people get 20-25%, like those people are all stars. And then I think about the private equity world. Even private equity world, when we think strictly about like leveraged buyouts of private businesses, they're looking at like 15% IRRs most of the times.
15 would be pretty low for a private equity. No, I thought they would get up to like the high teens to even over 20.
Yeah, so some will be, I think it ranges from 15 to like 25. Maybe some will go up to like maybe 40 if they're like really good, maybe like Vista Partners or something. Those guys would be very good. And I think venture capital, you can have that huge swing up to
like 10 times or zero.
Yeah, exactly. I think if you get like 15 to 25%, like you're still considered pretty good. But it's really rare to have that even in Canada. That's what I've learned from my own podcast interviews with other venture capitalists.
Correct.
So do you find though that because like that people consider infrastructure to not be as attractive because the IRR seems lower than the other asset classes, like traditional private equity, public equity, and
I think
like
if you talk to a regular Joe today about getting a 6% return, they will look at the market in the last like few years and be like, if I just buy into like an ETF, I would have generated like over 10% return, and they would be like, no, I don't think 6% is an attractive return, but and that's why most of the clients in infrastructure funds are not regular Joes out on the street. Pension funds is one type of fund that would really, or any sort of institutional funds would be interested in these type of returns for long term to protect their asset value, to make sure that they can still provide cash flow for the fund beneficiaries whenever they need. The institutional would be a big type of client, or high net worth who has a lot of money and they're not looking to double their money anymore. They're just looking to protect their net worth, and that is another type of investors that are interested in these type of returns. And so naturally they'll be looking at infrastructure as part of the portfolio.
Got it. And when we talk about the actual deals where you actually, I think we're kind of getting an idea of, okay, so usually when you have these assets, you have one giant client, the government, or an electricity grid provider who buys your energy. So it's funny, I actually interviewed back when I was looking at different investment opportunities. I interviewed with an infrastructure fund before, and that's where I also got accustomed to these terms of brownfield and greenfield projects. Could you care to explain that a little more to our audience, and what's the kind of split between brownfield and greenfield projects usually?
Sure. So if you think about projects, say a solar farm, for example, you can either buy a solar farm before the project has even started construction, or you can buy, after they've built everything, and then the solar farm is up and running, and all you're doing is buying pretty much a stream of cash flow for the next 20 years. And so the term brownfield means that, the grass has already kind of been dug, and so it's not green anymore, it's now brown. And so brownfield generally refers to projects that are up and operating, or maybe halfway through construction. I guess it would still be considered brownfield. And greenfield would refer to a project that has not dug ground yet. So you're taking on construction risk in a greenfield project, and sometimes even development risk. But in a brownfield project, you're taking on less risk and to kind of just buying that certain cash flow going forward. And that's the difference between the two terms. And so the returns that you're looking for in these projects, because of the additional risk that you're taking on, would generally be different. And but funny thing down in the States is that that there's so many capital chasing infrastructure that if you look at a brownfield solar project versus a greenfield solar project down there, the return, the premium paid to the greenfield is actually not that much higher. Like, people are paying pretty much assuming like very little construction risk and thinking that they're just going to construct it as planned, and we're going to get that stream of cash flow afterwards. And so it's a very interesting market down there right now, and it's something that I personally can't justify, and so I don't think it's very smart to invest in the greenfield project at such a low return, because if the construction doesn't go as planned, there's some sort of cost overrun, then your pretty much your whole investment case could blow up and you don't generate that return anymore.
And so from your experience, have you seen more brownfield or greenfield investments as better like opportunities?
Generally, I think brownfield provides less opportunity because your cash flow is fixed at that point, and there's very little upside you can get out of the brownfield because, as I mentioned before, your revenue is pretty much fixed. It's contracted.
So it's already been once it's built, then it's already been, the contract's already set, and then you're buying into it.
Exactly. So you can't really do anything to get more money out of it. Whereas in a greenfield, if you manage construction right, you can and you construct the project for lower cost than you initially planned, then your return on it would go up, and you could generate a very attractive return even though you're in the infrastructure space, and that's a way that a lot of the smaller infra funds are getting an edge over the big guys who usually buy into gigantic operating projects.
And so now kind of getting into then how would you actually do inside these infrastructure investing funds? My experience has been that when I was in consulting, I had a chance to do greenfield projects for renewable energy, and so a lot of my work was just heavy modeling, heavy Excel modeling, a lot of data, a lot of rigorous analysis on just making all these like KPIs go very specific. I was going down to mapping 15-minute intervals of sunlight for solar panels and going through NASA data to try to collect and figure out, okay, how much wind does this geographic location get, and trying to figure out, okay, how much energy will this wind turbine make, and trying to predict that with all these I think as small as 5 to 15-minute increments of data. And projecting that out for 30 years because that's how long we expect it to run. And subsequently, when I was interviewing for one of these infrastructure funds, the interview process was also going really deep into the nitty-gritty of modeling down to the number of nuts and bolts you would actually need to build like a hospital, for example. So can you kind of walk me through your kind of average week? Let's say you're in your role, and what does it look like? What are you doing?
Yeah, so there are mainly two parts to my job in the infrastructure investment space, and the first part is I will start out with the M&A part, and we're going out to look for new projects to deploy the client's capital, and so in this aspect, I would generally, depending on the project, a lot of times if it's an operating asset and they're running a deal, like a whole auction process, then you would look at whatever the client's providing you to get an understanding of the project. And luckily enough, we don't have to look at the 5-minute incremental solar data to try to forecast out the solar performance of the next 20 years. We actually, in the industry, everybody hires independent engineers who have access to these really large database of solar data and a bunch of other weather data, and they would run their own model and then they would write a report to say, at this site, the specific location, the expected solar installation for the next 20 years is this, and so your production coming out of these assets is expected to be this. And from this aspect, there's something called a P50, P90, and P99, and what those numbers mean is their probability numbers. So the independent engineers would look at the weather data and say that 50% of the chance you should be able to expect to hit this production level, and but if you go to lend and I think 50% of the chance I'm going to hit this production, and I don't want to lend this, I'm not flipping a coin on whether you're going to pay me back or not. So they have something else called a P90 and P99. Those are 90% and 99% chance of hitting that level of production. So maybe the lender would be more comfortable with that, and they would lend towards that level of production. And looking at the IE report, you can generally get an understanding of what production level can be expected out of that asset. And I would build a very detailed financial model because we're targeting a pretty low percentage return here. So if we miss any big items, miss any big costs, then that easily blows up your investment case again. So we need to make sure that we capture every revenue item to make sure we're paying for as high as we can for these assets. But at the same time, to make sure we capture all the costs to make sure we don't overpay, and that we know exactly almost how much it's going to cost to run these assets. And so yeah, a lot of financial modeling to build out an investment case. And after you model out your cash flow, you can we do a DCF, discounted cash flow valuation, and discount it all back based on the desired level of return that we think is acceptable for this asset. So, like say, an operating solar, we might think that a 7% return is reasonable, or 8% return. Then I'll discount it all back and see at an 8% return, how much can we pay? And given today's competitive market, generally you won't find any 8% return solar projects that's actually pretty high. And so from there on, we kind of adjust and see adjust the discount rate and see if we can get to a return we're comfortable enough and that our client is still going to be happy with. And that's kind of how we would value a solar project, for example. And from there on, I would prepare some sort of investment presentation to show it to our investment committee and get their buy-in. And then from there on, we would submit the bid and so on and so on. And so from the investment aspect, that's what I would usually do on a weekly basis if I'm on a deal. And the second part of my job, as I mentioned before, is the asset management part. So my company has we own a bunch of investments that are already built out and are in operations. So we're in that 20-year period where we're just trying to milk out the cash flow. And so from that sense, we have to make sure that it's operating properly and that we keep a financial model of what our expectations of the cash flow is, and we constantly update it with actuals every quarter to make sure we're performing according to plan. And me working in an investment firm, we need to always know, what's the value of each of our individual assets. So by updating these models, we constantly update our valuation of the assets, and that's what we get paid a fee on. And so I have to make sure I keep the valuation up and going, and talk to the ops guys, operations guys. We have some operations guys in-house who manage the assets, and talk to them to make sure that I understand all the issues that's going on at these assets, to keep a keen understanding of what it is, to report back to our clients. And that is the asset management side of things.
Okay, and so touching on the asset management side, so you have separate operations managers who are more, I guess, on site, and they operate, I guess they talk with the managers who also run a hospital, and then they get, I guess they collect the feedback, they get all the KPIs, and then they transfer that to you and tell you, okay, this is how this hospital is operating per se.
Correct. We generally, depending on the type of company, some companies have their in-house operating teams, they would the operating staff at the hospital might be on the payroll. Maybe not the hospital, that's pretty detailed, but say a solar farm, maybe the operators at the solar farm would be on the investment firm's payroll. But the company that I work at, we take a more high-level approach, and we have some ops guys who manage the process, but our company pays these operation and maintenance operators as a third-party company to operate the assets. So our ops guys kind of just manage how they're operating the assets and kind of get a good understanding to liaise back to the investment team, what's happening with these assets and so on.
Okay. And so when you're actually structuring the fund inside this investment company that you're working at, is it a separate singular fund per asset, or is it a fund that has maybe 3 or 4 different infrastructure assets in it?
Generally, the way my firm does it is either the high net worth or the institutions, they would say that, I want to invest 20% of my fund with the company into infrastructure, and then so that fund goes towards an infrastructure arm, and then from there on, they don't really get to pick which specific assets they invest into. And because of that, our firm focuses a lot on concentrations. We don't want to start buying a whole bunch of solar assets, because then the institutionals or the high net worth will look at a portfolio and be like, just buying a solar farm because I don't want to take on so much risk to the weather. Like, what if all of a sudden the world gets really cloudy and then I'm going to lose all my money? So they don't like seeing a lot of concentrated type or asset types. So we try to spread our investment across all of the different kinds of infrastructure assets that we can see to keep a diversified portfolio, even just within our infrastructure arm.
Okay. And I actually had a great, what I consider to be a great follow-up question, but it's kind of blanking on me. You might come back to it. But something else that also like triggered it is the kind of like deals that are happening, because it seems that you have singular big clients. It doesn't. I can only imagine that the deals are very infrequent. Like how often does the government start to build or decide to build another hospital, another school, or pave another highway? How frequent do these things come out, and what are the big, I guess, driving factors behind your deals?
For the traditional infrastructure type of investments, most of the time we don't really have an edge bidding into the RFP process. Say when the government decides to build a hospital,
RFP being request for proposal.
Request for proposals. So that's when they first have a mandate to go out and build a hospital. Then they will run the process to see to get a bunch of proposals to build it, and they'll select which party to go with.
Oh, okay.
From that sense, we don't really usually have an edge because most of the time the construction companies, they have their internal pool of capital to just bid straight into the construction process. So they don't want to have to share that return with the financial providers like us, and so we don't really have a lot of chance at those type of investments. When we look at the core infrastructure investments, most of the time we would be buying into an operating one where the construction company has built it up, but they don't want to wait 20 years to get their money back. So they want to sell it right now. And so they would run the sale process after they've built it up and operated for a couple of years. And that's usually when we would go in and look at it and see if we can build an investment case around it.
I see. So then that's the greenfield versus brownfield.
Correct.
Right.
But whereas for a lot of solar, say, renewable energy kind of investments, a lot of the constructors, they're not as big as the core infrastructure kind of construction companies, and so they don't usually have the capital to build out the project. They might develop it, they might gather all the solar data and build a whole investment case, but they don't necessarily have the capital to move forward with that investment case. And so through relationships and maybe auction processes, we would try to get into these kind of projects and help provide them the capital to build it out and earn a sizable return.
Okay. Do you think it's because the industry is still younger than the core side, that so these solar construction companies just don't have the capital at the moment because it's not as obvious or not as proven out?
Yeah, that, and I think the industry is just less consolidated. There's a bunch of guys out there who are trying to build solar, and they don't actually have a lot of construction. They don't have any construction companies that just go out and build solar farms. Most of the time, they have developers who go out and try to develop a new project and find a spot to put down the panels, and then they would get all the independent engineering reports and then build out a whole investment case. So they develop the project, and then from there on, from just selecting the right site and maybe signing a contract with the grid provider, and then from there they would just sell that right to build it there to a financial provider, and then the financial provider would buy into the project and then start finding the panel providers and then selecting a whole bunch of construction guys to do the project and move on from there. So there aren't actually like construction companies who just go out there and build solar. Whereas for hospitals and like highways, like we have actual construction firms out there who focus on these type of projects, and they are just much bigger because these projects are usually much bigger, and they don't necessarily just construct these type of projects. They might build other stuff too.
And so when you're actually bidding, whether it's a brownfield where it's already in operations and other infrastructure funds competing with you will put in a bid saying, okay, we want to buy this whole thing out, or even if it's a greenfield, let's say renewable energy type project where you want to finance the construction as well as and then own the solar farm or the wind farm, what becomes the edge then? Is it like, is it just a very relationship edge, or is it do you have more an internal ability to have better ops people to squeeze things out?
And that's why that brings me back to the point earlier of why the returns here are so low. Is because it gets so competitive in this space, and like over the past maybe 5 to 10 years, there has been a lot of capital chasing these type of investments.
Even in Canada?
Even in Canada, Canada is very, very competitive, and to be one of the winners in these projects, like you don't really have an edge on say revenue, because depends, like for solar farm, for example, like there's not a whole lot you can do to extract more power from the sunlight. If it shines, then you generate power. If it doesn't, then it doesn't. And so in an operating project, you would realize that most of the time the winning factor is how low of a return you're willing to accept. And that's why with more and more capital chasing these type of projects, the return level that people are willing to pay just keeps going down and down, because they're like, okay, we'll just take the 5% because we think historically the sunlight has been pretty reliable, and we're just going to take a chance on it and deploy some more capital in this type of return. And whereas if you go with a brownfield project, if you have a relationship with the developer, they might not necessarily run an auction process and ask everybody out there for a bid. And so with existing relationships, a lot of the time you can find these type of one-off good investment opportunities for your clients. But so that being the case, there isn't a whole lot of deals that infrastructure guys usually go for. I think my firm maybe would execute on 3 to 4 deals in a whole year, and that's all. And we think it's more important to look for good opportunities than to just blindly deploy our clients' capital at these like low returns and just try to earn fees off them, because we don't think that's a good business practice.
Mm-hmm. And so then when you're going through these opportunities, is it that they just pop up, like a banker brings you these deals, and then you just go through the model and see, okay, well, it just doesn't seem as obvious, and you just decide to pass? Is it as simple as that?
Yeah, a lot of deals come from bankers as the construction guys build up the project and they need to sell. They'll go to the investment bankers, and then the bankers will reach out to funds like us to be like, oh, here's an asset's coming up for sale. Let me know if you're interested. And then, we'll run my initial. There's usually 2 rounds in these type of investments, and that's in the auction process. The first round is just to give you like a little bit of the financial information, and then you model it out using that and see what kind of price you can bid for. And the price really at that level is just depending on how low of a return you're willing to accept, because the lower the return you're willing to accept, the lower your discount rate is when you discount all that 20 years of cash flow, and the lower the discount rate, the higher your NPV is today. And so generally on that stage, in an auction process, you don't have a whole lot of edge, and then you move into the next stage. Round 2 is where they open up a whole data room with a bunch of historical information on the assets, say their financials and their cost structures, what they've been spending on, and the capex, capital expenditures that they've been spending on to maintain these assets. And from there, you build maybe a slightly more detailed model and see where you can adjust and try to extract more value. And then, after the second round, they will usually select the winner, and the winner will get to take the asset.
Gotcha. And so once you actually invest in it and you've spent all this time, and as you mentioned, there isn't a whole lot of an edge that you have, but you want it. You got the deal. How often or how rare is it for the asset to just implode, just not work out?
Historically, like maybe like 5-10 years ago, it's a lot more, because that's when solar farms first started popping out.
Oh, so
I'm still on the renewable energy kind of space, because that's generally where most of the deals happen these days. In that space, like 10 years ago, solar panels costed so much. Nobody is really certain how much it's going to cost to build a solar farm. And so back then, you have a lot of people just bidding into these greenfield projects, trying to build it out, and they realize, oh, it costs too much, and we don't have the capital to finish the project, and then they have to abandon it. And like there were a lot more back then. Nowadays, it's a lot more stable. Generally, the panel costs in the past 5-10 years have come down so much. It's like a fraction of the price, like under 10% of what it was And so the cost to build projects come down a lot, and people know how to do them now because they've been doing it for a while, and so the construction risk generally is a lot lower. And so the really main risk here is the solar insulation level, like how much sun is shining onto your panels. And with the advanced modeling and analytics capability that we have these days, that risk is also a lot lower. You don't usually see projects performing so poorly because they've had like so many years of weather data, and generally they're pretty good at modeling out what production level you're going to get. You would think 50% chance is like pretty low, but most of the time the project would actually perform to around the P50 level. And so the chance of a project just really blowing up in your face is not very high these days. And I think they're very, very stable.
So I guess like even for core assets, where it's not even, so for example, like solar is weather dependent, but you have other ones that if it's just complete government paying dependent, you would literally need the government to collapse for the project to die, or
yeah, pretty much. Like you would get, otherwise you're just getting a fixed check every single month, and maybe some big. I personally don't look too much into the core infrastructure space, and I don't have a whole lot of experience in it, but generally the investments wouldn't be too bad in the space either, at least from what I've seen.
Got it. And so now when we look at the actual industry as a whole, from my outlook, I kind of see it as two different buckets, where you have the pension funds that you mentioned previously, like the Canadian Pension Plan Investment Board, CPPIB, and the Ontario Teachers Pension Plan, like OTPP, those two being the big infrastructure players. And there's also like smaller pension funds like the Health Ontario Pension Plan and like the BC IMC pension plans. And then there's the independence bucket, which is like, I think I would even put Brookfield inside there, even though they're massive. But Brookfield, Connor Clark and Lunn, CBRE Caledon, these more investment shops that are not pension backed. Like that's how I would kind of categorize these two buckets of infrastructure companies. But how would you characterize it? Is there a different way that the insiders look at it?
No, I think generally it's split up by either size or the type of investments you go for. Like we have there are companies out there who only chase certain types of assets, but I think, as I mentioned before, the space getting so competitive, I think those funds are less and less. Most people just kind of go for all kinds of infrastructure investments, whether it be the core or the core plus. Like people are just buying them because they need to deploy capital, right? You can't just have the client commit some money to you and you never deploy it, then it gets problematic, and they would want to pull the money out. And there's the type of assets which is less done. So it's more so split up by size. Some of the larger kind of projects, like hospitals or like Highway 407, that kind of projects requires a lot, will cost a lot of money. I think 407 is like $2 billion or something like that. And a lot of the smaller guys, they can't really buy into those because maybe they can find the capital to fund it, but then their whole fund turns into just owning the 407, and that doesn't make any sense. When people buy into infrastructure investments, they're looking for stability, and so diversification within an infrastructure fund is very desired. And so they like to see within an infrastructure fund that they're invested across a diversified portfolio of infrastructure assets. So you have some money in energy and power, so that have some energy in the traditional stuff like schools, hospitals, and then maybe if they are open to it, have some in the core plus space, where maybe some of the digital assets would fall into the core plus space, and they might be interested in that too.
Right, and the digital assets, are they things like smart cities? Is that part of that, or
it eventually will, depending on how the smart cities move forward. But like nowadays, today, the digital infrastructure is mostly data centers and fiber networks. I think there was like a fiber optic internet networks, and those are the main assets in this category right now. They're very investable. There's also stuff like telecom towers, but those are actually mostly bought up by that industry is very consolidated, and so we have very few investment opportunities in the telecom power space, but notice a lot of data centers are popping up left, right, and center, and these are actually pretty stable because if you think about it, the data needs is only forever growing, and people will need to find somewhere to store these data. And as the companies move towards cloud-based applications and the whole Internet of Things start growing, there's only more and more data that people need, and so data center is a good space to be in, and so is the fiber optic network space, because with all these data needs, you need fast ways to transmit these data, and so you need a good fiber optic network to do that.
Yeah, I think I've seen like real estate investment funds go into the data centers as well. Is that something you guys compete each other?
Yeah,
with?
that's why we call it core plus, and that's almost like core plus plus, because you're getting you're starting to venture really far out of the traditional infrastructure space. And but if you think about it, I think these assets still have infrastructure investment type of characteristics. Like they're very real assets. They're long term. Like the data center's going to be around for a long time. The contracts themselves might be shorter term because you're signing up with individual companies who they're probably not going to come into like a 20-year contract with a data center. But it's reasonably expectable that in say 10-year contract, at the end of the 10-year contract, they're still going to need data. And if that company doesn't need it, I would think that another company would probably need it. So a very strategically located data center has a lot of same characteristics as an infrastructure type of investments. But the real estate firms are also looking at it because some data centers out there, they're really just a box. You're just providing a box for people to build out their whole data center hardware. So they don't necessarily, it's not a turnkey kind of data center. Like people can't just be like, I need a data center, and you provide them the data center and run it for them. This one is more like, here's a good location with like all the networking equipment provided, but you have to supply your own hardware to run the data center there.
Got it. And so kind of switching gears to your experience being inside this infrastructure investments field, what are some kind of myths that you want to bust? Like, what are kind of some assumptions that your friends have of what you do that are just actually very far from the truth? Are there any?
I think the biggest one is probably the whole traditional infrastructure, thinking that that's the whole infrastructure space. But when I tell people I'm in infrastructure investing, they're like, oh, so you invest in highways and schools. But actually, I work very little with these traditional assets. Even though I'm in the infrastructure space, I only mostly work with renewable energy assets, just because of how much that space has grown in the past few years. So my focus is on power, and a lot of people don't realize that power falls under the infrastructure space, and so I guess that's probably one of the bigger myths. Other than that, I don't think there are too many other myths. Like infrastructure investing is, as people imagine it to be, it's a very stable type of investment. Like we don't got exciting stuff where we can double our money here. Like we're just trying to look for a good way to keep the value of money and grow it by a little bit more than what you can just putting it into the public markets or into a bond. And that's kind of the whole premise of the infrastructure investing.
Yeah, like nice and boring, right?
Yeah, nice and boring. And just like Dan's podcast.
Good one. It's true. I'm very famous for having a very boring life amongst my friends. And so that can be considered the unsexy aspect of the job. But for you personally, what about the job do you actually interests you and like excites you? And counter to that, what about the job sometimes frustrates you?
I find that learning, like before I joined the infrastructure space, I didn't know anything about how these hospitals and schools run. So or even airports. It was actually one of some of the deals that I looked at. And it was very interesting reading the contracts behind these P3 partnerships and kind of understanding how each party is passing risk on to the next one. And so the contractual aspect of it was very interesting to me when I first started.
Can you give me an example of like a specific moment where you thought, oh, this is a very interesting risk pass-off?
For example, I'm going to talk about an airport project. So
okay.
In airport projects, the risk. So we were buying into the project as an equity provider. It was already constructed. It was operating, And so you would think that, oh, you're taking on the operating risk, and if it costs you more money, then you're gonna lose your investments. But actually, all of the operating risk is passed on to the operator. If they don't operate according to the initial case, we actually just pay them a fixed fee. We don't really look at how much they spend. And if it costs them more than the fee to maintain the airports, then they're going to have to absorb the cost. So as an equity provider, I don't take on any operating risks, and my revenue risk is very minimal because I'm collecting money from the government. So I'm collecting a fixed amount of money, I'm paying fixed money. There's almost no chance that I would really lose my money, other than, and in that project, the only risk that was really there is at the end of the project, there was that rehabilitation risk that I talked about earlier, where you have to hand back the assets and you have to bring it back to a certain operating standard. And there's only really that risk, and even that, half of that was still passed on to the operator, and we only maintained a very minimal amount of risk. And I was looking at that project, and I'm like, I want to put some money into this. I want to earn that 6% of return in for the next 40 years for free. Like, I would borrow money and put all of that borrowed money into this, and that was kind of an interesting moment for me. And that was when I first started learning about the traditional assets. Because as I mentioned, I started out in the power space, so I knew a lot about the solar and the wind and all of that renewable energy power type of assets, but I knew nothing about the traditional. And that was a really interesting learning moment for me. I thought it was really cool. And outside of that, I think the part of the job that I enjoy a lot is a new project coming up, and there's these information that's available, and you're just reading as much as you can about these data or information provided by the investment banker or the client, and just doing your best to come up with a valuation and learning everything you can about these projects. Because if you compare it to, say, venture capital, they don't really they're never gonna dive deep into the nitty gritty of maybe how much cost they're spending, and they don't generally know that every project as well as we would. And we're here diving deep into details, and I like to have that feeling where I feel like I know everything about one project. I like to dive deep, and that's one aspect that I really enjoy about this job. Just going deep and trying to model every cash going in and out of the project and coming up with as good of a price as I can for that project.
Yeah, and I can only imagine that you actually gain an appreciation for these infrastructure assets when you see them. Like, I can only imagine that you know so much more about how airports might actually be operating compared to a regular person who's just waiting for their baggage at the Air Canada line, thinking, God, why? If I ran an airport, it wouldn't be like this.
Yeah, exactly. And it was also really cool I actually got to visit when I was in the power space, I got to visit some of these renewable energy sites. Like, I climbed onto the top of a wind turbine. So that was really fun. For people who are not afraid of heights. If you're afraid of heights, you'd be really scared because you're like 100 meters straight up into the air, standing on top of a wind turbine. The wind turbine stopped, so it's not spinning, so it's not going to hit you in the face. But you're just on a box suspended really high into the air, supported by this one gigantic pole underneath it. It's a really nice view, I'll tell you that.
And so then what about the job? You talked about how you love the nitty-gritty aspect, the ability to have more certainty over what you're actually investing in. And I guess that translates into the stability of the actual return profile. But what about it frustrates you or you find not as appealing sometimes?
It's the competitive part of the market with so many capital chasing these projects, as I mentioned before, like the return levels are driven super low. And you're almost like, sometimes I work really hard on these projects, and then at the end you find out that you lost because some other crazy guy out there is willing to accept a 5% return, and they just outbidded you because they put in a lower discount rate, and then all of those hard work that you put in kind of went down the drain. You didn't get to execute a deal, and you have nothing to show for it. And sometimes it could be discouraging. It's like a waste of time almost. You wasted like a week or two just working so hard on learning everything about the project, and at the end you don't get it. That part kind of frustrates me, and sometimes on these operating projects, you can't find an edge because everything's so contracted, and so a little bit lack of the creativity part, I would say, frustrates me. Personally, I like a bit more creativity in my job, and Yeah, so that part could be a little frustrating, but I still find it very enjoyable to dive deep into these projects and learning everything about it. And there's so many different types of infrastructure investments out there. Like I didn't even know anything about the digital space until a couple months ago when I started looking into it and helping my firm to maybe deploy some capital in that space. But before that, like I knew nothing about it, and I feel like the infrastructure space is always growing. Like it went from just hospital, schools, and roads to including renewable energy, and then now we're getting this new digital infra space. So the space is growing bigger and bigger, and I find it pretty interesting to learn about how all these assets that are around you every day, and it's very real, and learning how they work and assigning some value to it.
Mm-hmm. And what are your, I guess, just hours like on a deal versus no deal basis? How does that transition? Just so I can also, and our listeners can get an understanding of how crushing it is when a deal doesn't go through, like how much sweat you're putting into it.
It's actually they're very different. Like it depends on the firm, I guess, at the end of the day. When there's no deal and you're just kind of focusing on learning more about the space and maintaining your assets and keeping your investors happy, then nothing is really super pressing, and so if you like, you can leave anytime you want, really. And as soon as you're keeping up with these tasks and you're doing everything that you need to, then there's no reason to stay there till like 9-10 o'clock every day. And so at that sense, you can really leave at 5 or 6 if you want to. So it's pretty standard 9 to 5 on that sense. But if there is a deal coming, then sometimes you don't get looped into these processes, and these auction processes have really tight deadlines sometimes. And so you just got to stay there till whenever you finish your materials, because for me and personally, I have to prepare the materials, show it to like my managing director, and then there's a few turnarounds there, and then once we get comfortable, we got to show it to the president and then get him comfortable, which might take a day. And then after that, all of us together have to present it to the investment committee, who has to approve the investment before we bid into it. So that's another layer process. So because of that, like we have to get the materials ready a lot earlier than the bid deadline. And so if I'm working on a project, there are nights where you have to stay there till like maybe midnight. But it doesn't happen very often because generally at the beginning of a new bid, you have some time to manage. So you don't have to stay that late in the beginning yet. But as it gets towards the deadline, you realize that you have to start like really pumping it out. And so maybe a few nights afterwards, you would have to stay a little later. But I would say the hours are a lot better than most of the other investing space, like venture capital, private equity, way better than investment bankers. Yeah, so if anyone is interested in the finance space, I think, and you don't want to work crazy hours like investment banker, I would say infrastructure is a good balance of that. It's not just a standard 9 to 5, but at the same time, it's not going to be like you have to stay there till midnight every single day.
Mm. What kind of character traits have you seen amongst for you personally, and also just the people that you've worked with, where these are kind of key people with these kinds of character traits would be very well suited for this kind of role in this kind of investment space?
I would say attention to detail is very important, given that we're making sure everything is right here. We can't afford to have like any sort of big modeling mistakes, because that would really affect your valuation. So people in the space are usually they can look at a lot of stuff and immediately spot something's wrong, and their attention to detail is very high, and so there's that. And as I mentioned before, it's not a super creative environment, and so don't expect to be in meetings all day. Like a lot of times, you're kind of sitting at your desk and cracking away at these new projects, learning about it, reading stuff, and building financial models. So you have to be very comfortable like working alone a lot of time, yeah. So not super extroverts, attention to detail. Those are probably the two key traits. Like if you're willing to put in the time, I think it's not rocket science. You can learn the assets, and you just but to be happy doing it, I think those are the two key traits that you would need.
Yeah, that sounds just about right. It's also kind of similar to the people that I personally also know who are still in the infrastructure space. They are very detail oriented and quite introverted people as well.
Yeah.
Yeah.
They don't. There are not a whole lot of like super loud kind of character in the infrastructure space. Everybody is nice and calm. They are patient because if you're impatient, it's very easy to get too discouraged by not having executed a deal in a long time, and then you would not like your life.
And so then, for someone like me who is a retail investor, how would I try? How could I invest in an infrastructure investment? How could I go about doing that? Is it possible?
Most of the time, to invest into the smaller funds, it's impossible because we only the funds generally only target high net worth or institutional. There are actually a lot of public infrastructure companies that are like Brookfield, for example. You can invest in Brookfield, and they hold a lot of infrastructure type assets. And so you can do it through that way. But outside of that, it's not a very accessible space for regular Joes.
That's very unfortunate.
Yeah. Personally, I don't have any money in this space because I am not a high net worth.
It's true. I guess at least for people like me who are of the younger demographic, still it's still about wealth creation, not so much wealth preservation, which I'm guessing which is what a lot of high net worth people would want once they've had that wealth, and they're like, okay, now I want to live off this 6% yield.
Correct. And some of them are using this as like a means to pass money off to the next generation, right? Like they have no money to live for themselves, and so they just put some money in this and build up a sort of portfolio, and when their kids grow older, then they'll have a sizable portfolio to spend on.
All right. Well, I think we're kind of hitting on the final legs of our interview, and so before we kind of close off, is there anything that you wanted to share with our guests that we didn't have a chance to talk about, like that I haven't asked a question about, anything else that pops into mind about the field of infrastructure investing?
Nothing's coming to mind right now. I think we went into quite a bit of details of what it is and how it works.
Mm-hmm.
I hope everybody got a better understanding of what infrastructure is and they learned something new.
Yeah, no, I'm sure that I learned something new, and I even interviewed at infrastructure funds, so I got a lot of learning out of this. But yeah, so I guess I think we even I guess there really aren't that much skeletons to talk about in this industry. It is very plain and simple.
Yeah. That's how I like things.
Perfect. That's probably why you'll probably stay past your 3-year mark then, maybe.
I'll let you know when I hit that mark.
Sounds good. All right. Thank you so much for coming on the podcast and sharing your story and your knowledge with myself and my listeners.
Thanks for inviting me.
All right. Take
Cheers.
care. All right. Thank you for listening to the podcast. I hope the story was inspiring to you. Hopefully it also helped you expand your perspectives. Hopefully it also made you question the default path that you might have been going on, or the default beliefs you might have had. And maybe now it'll make you even think about doing something about it, doing something different, maybe challenging yourself, being courageous. Who knows? But regardless, I'm really happy that you took some time out of your day to listen to this fantastic story with my guest. And if you would like to somehow, in some way, contribute and help support the podcast, and maybe even just be part of the community that I'm trying to build with the greater OMD Ventures platform, really think about being a stakeholder in the platform. And the quick way to do that is to go to my website, oldmandan.com, and go to the stakeholders page. I believe it's oldmandan.com/stakeholder. And the link is also down below. And that's how you can figure out how you can subscribe, follow to get more updates on the free content, but at the same time also donate by actually just buying me a coffee. That's just how I put it. And you can buy me a coffee a month, coffee a week, or coffee every day of the year. And think about it as the way that, if you wanted to chat with me, you might just bring me out for coffee and buy me a coffee. Or if you wanted to bring one of my guests out to chat, you might buy them a coffee. So just think of it as I'm the service that's doing that for you, so you can just pay me in coffees. Don't worry, everything will still be free. It would just really help if you would like to show your support this way, so that I can use the coffee money to buy myself actual coffees, and also to buy my guests actual coffees and use the leftover money to actually grow the platform, as well as even keep it operationally alive as well, because it all this isn't really free, and it does take a lot of time to build it as well as operate it and hopefully grow it further. So your support would be amazing if you would like to contribute. And so yeah, just check out the website, go to the stakeholders page, and read the different kind of benefits you might even get as a stakeholder. All right, thank you.